Welcome to Sophie Daddy's channel. You know that feeling, right? You log into your brokerage account and it's just a sea of red. That sudden stomach-churning drop that makes you question everything. Well, that's exactly what happened on October 10th, 2025. Today, we're not just going to look at what happened, we are going to dissect it. We're going to build a complete strategic guide for turning that exact moment of panic into a moment of true opportunity.
Okay, so let's set the scene. On Friday, October 10th, the market, which had been pretty calm, just fell off a cliff. I mean, look at these numbers. The S&P 500 dropped 2.7%, its worst single day since April. And the tech-heavy Nasdaq, it got absolutely slammed, plunging 3.6%. This wasn't just a little dip, you guys. This was a broad, aggressive sell-off that had alarm bells ringing everywhere.
So, these are the two questions that really matter. They're what separate a reactive investor, someone who just gets swept up in the fear, from a strategic one who sees the entire chessboard. Panicking? That's easy. But understanding the why behind the drop and having a playbook ready to go, well, that's where the real power is. And today, we're going to build that playbook together. And here's our roadmap for today. First, we'll dissect the sell-off itself. Then, we'll talk about a super important concept for understanding risk, the Grey Rhino. From there, it's all about strategy, how to use volatility to your advantage, the 3 specific options tools for the job, and finally, putting it all together in a step-by-step action plan. So let's get into it.
All right, class, let's start our investigation. Because to figure out how to respond, we first have to know exactly what we're responding to. What was the spark that lit this whole fire?
The immediate trigger, believe it or not, came from a social media post. President Trump threatened another huge round of tariffs on China, and just like that, all those trade war fears came roaring back. The market's reaction was instant, and it was brutal. The sell-off was incredibly broad. I mean, look at that, almost every stock was down. And the tech sector, which had been leading the market, got hit the hardest. So here's the key takeaway. The catalyst was geopolitical noise, not some sudden economic collapse.
But here's the thing about sparks. A spark can only start a fire if there's a lot of dry kindling just lying around. And as this quote suggests, the market was full of it. The tariff threat was just the trigger. The real reason the drop was so bad is found in the conditions that made the market so fragile in the first place.
So let's look at that kindling. First, the market was coming off this massive 35% run-up since April, which created a dangerous sense of complacency. Valuations were stretched super thin. Stock prices had basically sprinted way ahead of what companies were actually earning. We were seeing a ton of speculative froth, especially in AI stocks, that felt, well, a little too much like the dot-com bubble. And all of this was happening while the economy was showing signs of weakening. The market was priced for perfection, and it got a sudden, sharp wake-up call.
Now, this brings us to what I think is the most critical lesson of this entire explainer, because to pick the right strategy, you absolutely have to correctly diagnose the problem. Was this just some random, out-of-the-blue shock, or was it something else entirely? This is where it gets really interesting.
We've all heard the term black swan, right? It's used to describe market crashes that seem to come out of nowhere. It's a totally unpredictable, unforeseen event. Think about something like 9/11 or the 2008 financial crisis. The key thing is, it's an unknown unknown. You just do not see it coming.
But there's another animal in this risk management zoo, the Grey Rhino. A Grey Rhino is a huge, obvious, highly probable threat that we can all see coming from a mile away. But for some reason, maybe complacency, maybe denial, we tend to just ignore it, right up until it starts charging straight at us.
And this table just lays out the difference perfectly. The October 10th sell-off was a textbook Grey Rhino. The catalyst wasn't a surprise. It was a threat of tariffs, a political move we've seen time and time again. Now compare that to the April crash, which was a true systemic shock triggered by the actual implementation of brand new massive tariffs. The October event was driven by sentiment and fear. The April crash was driven by a real economic shift. And understanding this difference, well, it changes everything about our strategy.
Okay, so we've diagnosed the event. It's a sentiment-driven Grey Rhino. So now let's pivot from diagnosis to action. How do we take all that fear sloshing around in the market and turn it into our advantage? The answer comes down to one powerful word: volatility.
This slide right here is the key to the whole opportunity. When the market panics, implied volatility, which is basically the price of options, spikes. For anyone trying to buy options, that's a huge problem. Everything is suddenly super expensive. But for option sellers, oh, it's a massive tailwind. You get to collect way more premium for taking on the same amount of risk. You literally get the chance to sell fear when fear is at its absolute peak price.
So, if our game plan is to take advantage of this volatility spike and get ready for a likely rebound, what are the best tools for the job? We're going to break down 3 specific option strategies that are almost tailor-made for this exact environment.
First up, selling cash-secured puts. This is just a fantastic disciplined strategy for a moment like this. You find a great company you'd want to own anyway, you sell a put option below its current beaten-down price, and you immediately collect a nice fat premium because everyone's scared. From there, one of 2 good things happens. Either the stock bounces back and you just keep that premium as pure profit, or the stock keeps falling and you get to buy that great company at an even bigger discount. It's a total win-win.
Our second tool is buying leap calls. Now, leaps are just long-term options. They have more than a year until they expire. They're a really capital-efficient way to bet on a long-term recovery. But, and this is a huge but, so listen up, timing is everything. If you buy leaps right in the middle of a panic, you are paying top dollar because of that high volatility. The smarter move here is patience. Keep this tool in your back pocket and wait for the fear and the price of these options to come down first.
Okay, before we get to our third tool, I have to make a really important correction. This is a super common point of confusion, so let's get it straight right now. A lot of people hear credit spread and think of a call credit spread. But that is a bearish strategy. It profits if the market goes down. If we are betting on a recovery, the correct bullish credit spread is the bull put spread. Getting this right is absolutely essential.
And here it is, the bull put spread. Honestly, this strategy is probably the most elegant tool for this exact scenario. You sell a put, and then you buy a cheaper put further down, which strictly defines your risk. You collect the net credit right up front, but your maximum loss is completely capped. This brilliant structure means you can profit if the stock goes up, moves sideways, or even drops a little bit, all while that high volatility is working in your favor. It's a high probability trade with built-in armor.
So, we've identified the event, we understand the volatility dynamic, and we have our 3 tools. Now it's time to put it all together. See, a great strategist doesn't just have tools, they have an integrated plan for when and how to deploy each one.
And here is that plan. In phase 1, the first few days of the panic, your job is to harvest peak fear. This is when you deploy your premium selling strategies, your bull put spreads and your cash-secured puts. Then, in phase 2, as the initial shock wears off and volatility starts to drop, you pivot. This is when you start buying your leap calls at much better prices. And finally, phase 3 is all about management, closing your spreads for profit, dealing with any stock you might have been assigned, and just letting those leaps do their thing as the market recovers.
Think of this table as your strategic cheat sheet. It sums up the entire game plan. You can see which strategies are best for phase 1 because high volatility has a favorable impact on them. And notice how the bull put spread has a defined risk profile? That makes it the safest first move. Then, as you move into phase 2 and 3, you bring in the leap calls, accepting that initial unfavorable volatility impact in exchange for that powerful long-term leverage.
So, if you remember just one thing from our lesson today, please let it be this. This sell-off was not a sign that the whole financial system was breaking. It was a sharp, painful, but ultimately sentiment-driven reaction to a known risk. And the great thing about sentiment is that it can change just as quickly as it's soured.
And that really brings us to our final, most powerful point. This isn't about gambling or just blindly buying the dip. It's about having a systematic, phased plan. By understanding what's happening and sequencing these strategies in the right order, you can methodically transform the market's collective fear into your own personal strategic advantage.
The market panicked, but now you have a plan, you have a framework. So the next time you see that big, obvious Grey Rhino charging down the street, sending everyone else running for cover, are you going to join the stampede, or are you going to calmly open your playbook and see the incredible opportunity that everyone else is missing? The choice is yours.
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.